Hello, everybody. Good to see everybody. We will be starting at in a couple minutes. We want to give people an opportunity to just to show up. So we'll be here. We'll start shortly. I want to thank everybody for being here. And we've had the question: is this going to be recorded? Of course, it will be recorded. And I'm looking forward to presenting to all of you. So we're going to give everybody, another couple of minutes to get going, to get here, and then we'll begin. Hello, my name is Mark Sebastian. I am the founder of OptionPit.com, and this is Options for Risk Management. I want to remind everybody this is for education purposes only, should not be considered investment advice. Options have risk. Consult with a financial professional if you have questions. And let's begin. So I want to tell you a little about myself. If you don't know who I am, my name is Mark. I was a floor trader for about 10 years. Then I left the floor. I started OptionPit. What is OptionPit? OptionPit is an education company that teaches retail and independent traders how to trade and think like a professional. We also work with money managers, asset managers, registered investment advisors, teaching them how to implement option strategies. Basically, we teach investment advisors to think outside the box of just buy and hold and forget about it and pay me a fee. On top of being an educator, we also run a couple of small hedge funds. We have a vol fund that trades volatility and a fund that is a smart S&P 500 fund that trades the S&P 500 with a hedge. So you are listening to someone that not only teaches you how to trade, but actually trades. That's a rarity in this business. So let's talk about what we're going to discuss. We're going to talk about what is risk management, a money management plan. I'm going to talk about portfolio management, a trading plan, and I'm going to talk about ways to use options as a risk mitigating tool. So what is risk management? This is always one of my favorite slides because I typed in risk management into the Merriam-Webster dictionary.com, And, this is what came up. So what is risk management? Well, when I was in college, we had a risk manager in my fraternity. His job was to make sure that the fraternity didn't get busted and get in huge trouble. When I was a trader, I had a risk manager to make sure that the trading firm I worked for didn't blow up. And as a individual investor, I think about trading this way, risk management. For an option trader, risk management is taking a risk in the most capital efficient manner as such to receive the highest possible return for the fewest amount of dollars at risk. But how do you do that? And this is where we came up with what I call the option pit 3 pillars: trade structure, risk management, and the efficient use of capital. Maybe you needed an Oxford comma in that sentence, but who cares about Oxford commas? So let's talk about how to understand risk and how to really become your own risk manager. And it starts with understanding things. So anybody here a plane pilot? Anybody ever flown a plane? Yeah, people here are saying, yeah, I've flown a plane. So before you fly a plane, how many hours of classroom are there where you have to learn how a plane works? The answer is hours and hours and hours. Why? Because if you understand how a plane works, how it really functions, when something goes wrong, you are prepared. That is the key to options. Airplane pilots take lots of time learning how the plane works. Option traders sometimes don't take near as much time as they need to learn how options work. If you understand how options work, then you can manage risk. So, how do you start to learn how to manage risk? And it starts with understanding the instrument of an option. So how is an option different from an equity that you might hold? How is one option position different from another? Learn the workings of that instrument intuitively. What does intuitively mean? What does intuitively mean to you guys? I think Jay said it perfectly. He said, without conscious thought. That's correct. Intuitive means that you have an understanding of things without having to think about it. So my wife, Lauren, was a fashion buyer. She was a clothing buyer, a clothing wholesaler, and now runs a big fashion blog, a fashion news website. And the reason why she's so successful of it is because she doesn't look at a pair of jeans as just a pair of jeans. She looks at them as a pair of, flare jeans with, flare jeans faded with acid wash, blah, blah, blah. She knows all the different pieces of it. She knows that red is not red. Red is magenta or whatever color they use in fashion news. So she's quick to be able to look at an outfit and go, this is what that is, and I know how to find it. You need to have that ability with options before you become successful. So where do you start? First, again, understand that instrument. So then what is the steps to options being intuitively aware of options? So it starts with, do you understand the basics? Do you understand a quote? Do you understand expiry? Do you understand synthetics? Synthetics are how you can convert a call into a put and vice versa. Next, do you understand how the pricing model works? Why is an option priced the way it's priced? Do you understand how the Greeks work? Greeks are an output of the pricing model. They are part of modeling. Do you understand that? And do you understand how they work? All right. If you can get to here, then we can talk about letting you trade an option here or there. And then finally, if you want to be a pro, if you want to really make a lot of money trading options, do you understand what the non-modeled risks of options are? So modeling is only as good as the model. There are risks in options that you really have to understand the option contract itself in order to understand where the risks are. Things like gap risk. You get here, now you're ready to trade. Now you're ready to be a risk manager. You are your own risk manager. Your dollars are yours, right? You're not representing a company, you're representing yourself. So it's your job to protect your own dollars. So you are your own risk manager. Although in some cases, maybe you have your wife being like, hey, are you losing money today or making money today? Or your husband. But that which is a good check, but really, you need to be your own risk manager. So why do you need to know theory? I get this a lot. Mark, all this seems like a bunch of hullabaloo, phony baloney crud. I don't need to know this stuff. I can just look at a pretty chart on Thinkorswim or Sterling or IB or whatever. But you need to understand that those are built on models. If you don't understand how the model works, then you don't understand how your chart, your risk graph, can fail you. When the inputs in the model change, your risk graph changes. It's annoying. Going through that whole process of really learning how options work is annoying, but it's worth it. Because if you spend the extra few months learning how the model works, you will actually make money faster than just going in and trading. So by understanding the model itself, you're going to understand the cause of risk, and that is the key to managing risk. So this is a picture of the S&P, and I want to show you, like, this is one model, one risk graph that I like this, but it's not perfect. And what I want you to show you is you can see how, based on these guys, how risk can change. If time passes, you end up here. If volatility changes, you can end up here or here. And if things remain the same, you'll end up here too. So risk changes, and the only way to understand how risk changes is to understand the model. Another thing, and this is actually shocking sometimes, understand the contract you are trading. It sounds simple, but is it? Well, let's talk about the S&P 500. How many different ways are there to trade the S&P 500? All right, well, let's talk about it. You have S&P 500 futures. You have SPY options, S&P 500 futures options. You have cash index mini options, cash index big options. You have mutual funds. There are 1,000 ways to trade the S&P 500. So if you don't clearly know the dollars at risk, you might be in for some trouble. What are the dollars at risk? What is the multiplier? What does it expire into? When does it expire? I mean, some S&P 500 contracts expire into cash, some to futures, some to the equity. Some expire into futures sometimes and cash other times. Think about that. There's a lot. So now, once you have a real clear understanding of what you're trading, that's the first thing. If you don't know what you're trading, don't trade. Don't throw your capital away, and that's something we're going to talk about in a minute. Once the trader is actually ready to trade, the next step is to build a money management plan. A money management plan will allow for how much of an account will be engaged in the market and how much money is allocated as it's engaged. We call this VAR. V-A-R, VAR. That is a acronym for value at risk. That's how much of your dollars are at risk. I have one fund where we put a lot of the dollars at risk. I have another one where we only put up to 10% at risk. So the questions you need to ask yourself: what kind of money do I have to work with? What is my goal rate of return? How can I allocate capital so that I'm able to achieve that rate of return? Can this be done without the risk of blow up? Is the plan efficient and does it scale? So let's hit these points. Now, different accounts warrant different approaches to trading. But, and I know you guys are guilty of this, do not treat any capital lightly. All capital is a part of building success and wealth. There is no such thing as throwaway capital. Who here, and be honest, has said, man, you know, if I lose this, I lose this? Who here said something like that? Be honest. You know, nobody can see your answers other than me. I won't say your name. Who here said that? So I'm seeing a bunch of yeses. Now, I want you to think a second. If you gave your money to me or in my hedge fund, and I said, man, if I lose a little bit, I lose a little bit. You know, it's worth playing in. Who cares if I lose, you know, X amount of dollars? If your investment advisor, if your money manager, if your financial consultant said, you know, it's only $5,000. If you lose it, he loses it. Do you think you would want that money manager having your money? The answer is no. You'd fire that guy in a second if you overheard that, right? So you need to put your mind in a way that you would view somebody else with your money. If you don't have that mindset, you shouldn't trade your own dollars. Treat every dollar as if it matters. It's only a $5,000 account is maybe the single dumbest thing I've ever heard. If you have said it's only, then insert dollars and then account, who cares? I don't care how much money you have. I've met a lot of really rich people. You know what they don't do? Is blink at a couple $1,000. It's only a $5,000 account. Well, let's think about what a $5,000 account can buy. This is a 2000 Ford Mustang. Got a nice air scoop. Look at that air scoop right there. Got some nice wheels. I mean, that's pretty. I can go on eBay and buy it now for $5,000. So would you rather throw a bunch of capital at the market to learn, or have a 2000 Ford Mustang with an air scoop and some sweet tires to have at home? Think about what your dollars can actually buy you. 10 grand buys a lot. $5,000 buys a lot. I mean, $5,000. $5,000 is, for some people, 4 months of mortgage. For some people, 2 months. For some people, 1 month. For some people, half a month. Either way, think about those $5,000 the same way you do when you write the check for your mortgage. Don't be dumb. So would you rather blow $5,000 in an account or have a 2000 Ford Mustang with a sweet air scoop? Don't be stupid. You'd be surprised how stupid people are. I'm not saying it's you, but it's a surprising amount of people that are here. Now, let's talk about return. And this is where you need to talk about being realistic. So be aware of what a realistic rate of return is. Is 5% a realistic number? Compounded, that equates to 80% of the year. 2% is 26% a year. Be realistic about your expectations. Having silly expectations produces silly risk management and silly risk mistakes. So now here's the second part. How much of an account should stay in cash? What is the target rate of return to achieve that goal rate of return when you have 70% of your money in cash? If I'm only trading 40% of my account, is an 80% return realistic? All right, next, ceteris paribus. That means all things equal. How would you allocate your capital? And then you have to allocate capital across different trades. Next, risk of blow up. When allocating capital, one common mistake is the too much of a good thing approach. People that are like, oh, I do one big iron condor every month. I do one big iron butterfly every month. I do a calendar plan every month. You need to be diversified. You need to be aware of the risks of long and short premium. Be aware of the maximum loss in a catastrophe. People always fail to think about a catastrophe. So the first rule of risk management, and if you want to leave now, leave with this note. Never be in a position that you're not able to trade the next day. And then finally, never be short units. What are units? Units are cheap options. Cover them. I'll give you an example. So my fund that matches that tracks the S&P, we were short puts to express our long exposure to the S&P 500. We were short them at a really nice price, and yesterday I had the opportunity to buy them back for, call it 90% of the 90% lower than the premium I had sold. You know what I did? I covered them. I paid $3 for the puts I had sold. Today, at the peak of the sell-off, you know where those puts were? So just an FYI, today is February 7th, and at the lows, the S&P was down close to 45 points from 2730 down all the way near 2690. I had covered the 26.5 puts. Do you know where the 26.5 puts traded today as high as? Over $10. So if I was short 10 of them, let's say, that means that I would have seen a $7,000 P&L swing. Or, even more, I could have sold them back and collected an extra $7,000 in premium on a 10 lot. That sound like risk management? Yeah, that is risk management. Those $3 puts were units. Adam says, one mistake I've seen is having several trades on, but ultimately they were the same basic trade. Correct. That is a common mistake. People think that calendars and butterflies are different. They're not. Butterflies and condors are different. They're not. Short premium is short premium. Long premium is long premium. Think about it that way. If you sold out, if you're a net seller of premium, you have a position on. If you're a net long owner of premium, you have a position on. So then the next question is it scalable? And this is an important question for you small traders. A real trading plan should be planned for $200,000 or $2 million, not $20,000. If you would not trade $2 million the same way you're trading to $20,000, guess what? You shouldn't trade that way. And this is true. We were talking about this today. I was talking about this with Leisha, my DO, who's also an ex-market maker. Retail traders take way, way bigger risks than I ever took as a market maker. The risks that many of you take would have gotten me fired. Now let's talk about the trading plan. This is the nitty-gritty of our capital allocation plan. So you start by listing out all the trades you might trade. Condors, flies, calendars, straddles, strangles, you name it. It assumes all are tradable but not in spectacular condition. You then allocate how much you put of your dollars in each of those trades. Next, you adjust the size according to the conditions in the market. After that, put into place restrictions on losses and target gains. And then you cover your adjustments and insurance if you want insurance. I used to be a big believer in insurance. The more I look at it, the more I'm not sure it's worth it. I'd rather engage in what we call just-in-time hedging than actually carrying a bunch of insurance. So finally, you adjust your allocation according to what trades are more or less favorable. You go and find the edge, we would call it. Where are you going to make the most money? So if butterflies are better than everything else, you do more butterflies. If condors don't look good, you don't trade them. If butterflies look great, you obviously trade them. Then you find something that'll offset that risk. And then you remember, cash is a position. So now, what is the most important part of managing risk? And it starts with picking good trades. Good trades makes risk management easy. Who here knows how to spot a good trade? And a good trade is not, it's 30 days to expiration. A good trade is, this has statistical odds of making money. A lot of people get confused on that. You know, one of the biggest lies, in fact, probably the biggest lie propagated in the options industry is that it's a huge money maker to be a seller of options. Who's heard that before? Sell options because 80% of options expire worthless. Who's heard that before? I'm seeing a lot of people say yes. All right, well, what part of that are they leaving out? What part are they leaving out, you think? What about that 20%? The part they don't leave out is, how much money do you lose when they actually end up in the money? Options that end up in the money don't just end up in the money. They end up in the money by a lot. My friend Russell Rhodes did a study on earnings. He sold and bought straddle on every single earning stock for like 10 years. And you know what he found? Do you think he found that the option buyers made money? Do you think he found that the option sellers made money? What do you guys? So the answer was nobody made money. Both buyers and sellers lost money. You know how much they lost money by? The average of the bid-ask spread. So the point of that is that if you don't know that you're in a good trade, the odds are not in your favor. They're not. Don't believe that garbage that you're sold. So the point is you need to learn how to make a good trade. If you don't know how to make a good trade, stop and learn. You're spinning your wheels. You're giving up a nickel a contract on every single trade you trade, plus commission. So how do you enter good trades? Take the time to understand what are the best conditions for each trade, build an adjustment and closing plan. So what is the most important part of managing risk of a trade? And that's picking good trades. Oh, you know, sorry, I thought this moved. So here's what you do. You write up the optimal conditions, normal conditions, and no trade conditions for every trade. If all you do is drop a trade on these no trade conditions, now you're in a position to win. Then you write up an adjustment plan for any potential conceivable move. What if the underlying rallies and IB is down and falling? What if the underlying rallies and IB is up and rising? What if the underlying falls and IB is up but falling? What do? There's 20 different combinations, but you need to be prepared for all of them. And now here's the key to adjusting. Set a maximum loss for each trade. This is the level that a trade is pulled. Set an absolute max loss. What is an absolute max loss? Absolute max loss is the amount of money you will never let your position lose under any reasonable scenario. What is reasonable? You wake up tomorrow and we're down 3% or 4%. For a condor, the maximum loss might be the same as target profit. Absolute max loss might be how much you took in. And why do I use 2 max losses? Because one of the hardest things for traders to deal with is when a trade is down but not at max loss. What do? A lot won't adjust, or they'll stay in overnight. But if absolute max loss is within 1 standard deviation, adjust or close. Adjust or close if you're in 1 standard deviation of absolute max loss, or 2 for that matter. It'll save you money. So now, adjusting. A lot of people love adjusting trades. They think they can do some sort of options kung fu and turn every trade into a winner. right? Who's seen these people be like, well, I did this, and then I did this, and I did this, and then I ended up making money. Yeah, again, seeing a lot of yeses. But what these traders end up doing is really throwing capital at a trade. What is throwing capital at a trade? It's jacking up margin, jacking more and more and more margin, rolling and increasing size, more and more margin, more and more margin. They think they're a bottomless pit of capital. Problem is, most traders are not bottomless pits of capital. So keep return targets and your maximum loss off of your original trade. Don't open up cheap options and stay contract neutral. What does contract neutral mean? Contract neutral means if I get a 10-lot butterfly, it means I bought 10, sold 20, and bought 10. Butterfly, right? That means when I make an adjustment, I'm still long 10, short 20 options, and long 10 options. Maybe at different strikes, maybe at different levels, who knows? But I've not added a lot of options to a trade. If you're going to change your contract neutrality, when we do that, we are buying options, not selling. So who has questions about general approaches to risk management? Ask away before we get into some smart ways to trade options. Before I introduce some pretty basic concepts, but talk about how to do it and why. Today we're going to talk about covered calls, protective puts, risk reversal. So covered call. So what do I like about covered calls? An owner of a stock can increase returns by selling upside premium. It sets a level to get out, and this is the number one mistake of equity investors. Equity investors fall in love with stocks all the time. You know, I do a radio show called Option Block, and someone gave our podcast a 1 star. And when in the reason for the 1 star, the person who left the rating said, Mark Sebastian said something bad about Apple. Think about that. Mark Sebastian said something bad about Apple, so this podcast gets 1 star. You think that guy was in love with Apple? You know, this is when Apple was, you know, certain, you know, call it $100 split adjusted. So 100 shares for 10 grand. If you offered that guy $10,000 cash for his stock, or let's say the stock was worth $10,000. If you offered that guy $12,000 for the stock, he would say no. You said, all right, I'm going to give you $12,000 for your Apple, worth 10 grand, but you have to wait 2 months before you buy it back. The guy would have said no. So what I like about covered calls is you sell a covered call and it gets you out of your position because the stock gets called away if it runs hot. It produces income on stocks that sit. And a lot of stocks stick. It sets a top for a long position, and it saves the trader from the out. And it's unique because it produces income. And this is what it looks like. You know, I'm long the stock, and I'm short the call. Well, let's think about what we have here. I'm long the stock for $167. And I'm collecting, let's say, for simplicity, $3.75. Well, I'm getting 2.5% yield on just selling the calls. What do I mean, stage trader from the out? A lot of traders aren't sure when to dump their stock. If you sell a covered call, you now know when to dump your stock. So on this covered call, I'm getting 2.5% yield. And if the underlying rally, and I still have $4 in the underlying rally, another 2.5%, 5%. If I buy the stock and sell a March call, March is 40 days away. Would I be happy with 5%? Yes. Question is, what delta do I pick on sold call? I don't just pick delta. I pick kind of where I think the stock's going to go and where I'm willing to sell it. Obviously, I want a certain amount of yield. I don't sell covered calls with a yield lower than 1% for a month. So 30 days, I need to have a 1% yield on my sold call. If I can't get it, it's not worth it. And this is what a covered call looks like. You track the stock up, and eventually you get taken away. Getting your stock called away is a good thing. It means you made money. The refusal of people to take money because they don't want to pay taxes is numbing to me. I'll tell you, thank you. I have never thought about taxes when making a trading decision ever. Well, let's talk about using puts. Puts can be used to set enter and exit point. Buying a put will set a floor, but it has a cost, that insurance value of the put. And over the life of a hedge, hedging may be more expensive than the losses it prevents. Purchase puts should be used as a wealth preservation tool, not as a wealth appreciation tool. You buy puts when you have what's called a concentrated position. So for instance, I was on the phone today, one of my consulting gigs. The guy held 11, he works for the company, and he holds 11,000 shares of a stock worth well north of $100. You think that's worth something to him? You think he cares if that $150 stock, if he sells it at $140? No. But he really cares if he has to sell it at $100. You think he cares if he spends $10 to protect his $2 million? Does he care about losing $100,000 to protect $2 million? No. If you are in that position, you should use protective puts. If you are not, you stop and sell your stock into risk events. Yeah. Now, selling puts, on the other hand, are great for setting up entry points. If you just buy stocks and instead of selling puts to enter, you are missing out. You are leaving a lot of money on the table. Traders can sell puts in names they want to own, collect premium, and then hopefully buy the dip. Apple, for instance, was a great buy the dip, and I want to show you something. So I do some freelance writing for TheStreet.com. I'm Jim Cramer's VIX guy, apparently. Anytime there's VIX stuff, he has questions for me. There we go. Look at that handsome guy right there. Look at that guy. Seen a guy that handsome in a while? No. Kidding. So let's go back to when Apple was absolutely tanking. And what I said was, at this point, Apple was so cheap that I was happy to get into it. And what I said was sell the July 145 puts at $13.50. Take delivery. So, what do you think that option is worth now with Apple at 170? No, you didn't. I could have bought the stock for, 144, and I would have had more upside, or bought calls. But vol was really high. So I was willing to take delivery below 145, but instead I said sell these July puts at 13.5. I think they're worth about $5. This is the perfect use for put selling. I've got a level I'll get in, and I'm enjoying it. Here's a protected put in Apple, right? I'm an investor in Apple. I've owned it for a while. I own 10,000 shares worth $1.7 million. All right, well, guess what? If you have $1 million in a stock, if you have a stock that's worth 50% of your income, go ahead and buy protected puts. Obviously, there's smart ways to do it. But this is your standard protected put, and this is what it looks like. Now, if you know your synthetics, what does protected put look a lot like? And what does a covered call look a lot like? Protected put looks a lot like a call, because it basically is. My covered call looks a lot like a short put. Things to think about. Here's a put sale. In this case, I've set up a put spread. For a mutual fund portfolio, how do you hedge? I would argue that the mutual fund is outdated, and you can recreate your mutual fund portfolio with ETFs that have options, and you can manage that. Alternatively, you can engage just-in-time hedging with something like VIX futures, VIX options, things like that. But I personally am not a fan of mutual funds. And I wouldn't run a hedge fund that didn't have a hedging program already installed, which I do. So let's talk about the risk reversal, sometimes called a collar. This is a combo of protected put and a covered call. This I'm okay with. Again, great for traders with concentrated positions. It's great for risk-off trading. I'm worried we could have a major sell-off. All right, risk reversal time. And it can be used strategically for just about any position. This is what it looks like. Here's Apple. Apple's had a nice run. I think I own some of the stock. I bought it at 142. It's now up to 167. Well, I don't want to lose it if it tanks again. And I want to get some yield out of it, so I do a risk reversal. I sell a call, and I buy a put. I buy the 160 puts, I sell the 170 call. And what do you notice about the net of this trade? What am I getting out of this risk reversal? The answer is a credit. Do not do collars that you have to pay for. If you have to pay for a collar, that tells you the market is terrified and it's probably time to think about taking your money off. And that's what a collar looks like. So in summary, understand options to understand risk. Charts can change. All capital is precious. Learn the uses of options for stock trading. Use puts to enter, not exit if you can, unless you're concentrated. So what do we got? Well, Saturday, February 9th, starting at 9:30 a.m. Eastern Time. We have our special Saturday class, options for investors. If you own stocks, you need to take this class. We're going to teach you how to understand the Greeks, how to use options to express investment decisions in a lot more detail than I'm showing you now, how to invest income for weekly and monthly options, and how to manage risk professionally across a huge portfolio. So when you go to sign up, the cost of the class is $297. Tomorrow, when you pay for it tonight, tomorrow I will rebate back $100. $100. And if you use code 25_off all capitals, you can take an extra $25. So you're going to get a 4-hour class for $172. When this goes in our store on Monday, it will sell for $297. And if you take the class and you hate it, I'll give you your money back. The alternative, Saturday classes are free for OptionPit Live subscribers. OptionPit Live is $125 a month. Do the math. So you can go to optionpit.com/risk class to sign up for the class directly, or go to optionpit.com and sign up for OptionPit Live, and you'll get the class included, plus you get access to our chat room for a month. Yes, Junkie, you can. That's the beauty. You sign up for a month of getting access to our chat room. I'm in there every day for an hour. You can ask me questions, access to me for $125 a month. Or if you say, you know what, I don't want to be involved with anything that might be a subscription, you can pay the $172 and you're a happy camper. Any questions? All right, I want to thank everybody for coming. If you have questions, you can email us, info@optionpit.com, or call us. Again, www.optionpit.com/risk class. Hope everybody has a great evening and a great weekend.